Differences between accounting profit and taxable income are a fundamental aspect of financial reporting and tax analysis because financial accounting standards and tax regulations often apply different rules for recognizing revenues and expenses. The program explains that accounting profit is determined according to accounting standards such as IFRS or US GAAP, while taxable income is calculated according to tax laws established by government authorities. These differences create temporary or permanent gaps between reported earnings and taxes payable. Analysts must understand these distinctions because they affect deferred tax balances, cash flow timing, profitability analysis, and earnings quality. Proper analysis of tax differences helps investors evaluate future tax obligations, sustainability of earnings, and overall financial performance more accurately. Temporary differences arise when accounting rules and tax regulations recognize revenues or expenses in different periods, although the total amount recognized over time remains the same. Common examples include depreciation methods, revenue recognition timing, pension accounting, warranty expenses, and inventory valuation differences. For example, accelerated tax depreciation may reduce taxable income in earlier years compared with accounting depreciation, lowering current taxes payable while increasing future tax obligations. These timing differences create deferred tax assets or deferred tax liabilities on the balance sheet. Analysts evaluate temporary differences carefully because they affect future cash flows and may reverse over time, influencing long-term profitability, tax expense trends, and assessments of earnings sustainability. Permanent differences occur when certain revenues or expenses are recognized for accounting purposes but never affect taxable income, or vice versa. Unlike temporary differences, permanent differences do not reverse in future periods and therefore do not create deferred tax balances. Examples include tax-exempt interest income, fines and penalties that are non-deductible for tax purposes, or differences in allowable deductions between accounting standards and tax law. Permanent differences influence a company's effective tax rate and may cause accounting tax expense to differ significantly from taxes actually paid. Analysts examine these differences carefully because unusually large permanent differences may affect profitability comparisons across firms and provide insight into corporate tax strategies or unique business circumstances. Deferred tax assets and deferred tax liabilities arise directly from temporary differences between accounting profit and taxable income. Deferred tax liabilities represent future tax payments expected because taxable income is currently lower than accounting income, while deferred tax assets represent future tax benefits resulting from currently higher taxable income or deductible losses carried forward. These balances are measured using expected future tax rates applicable when temporary differences reverse. Analysts assess deferred tax balances carefully because they may represent significant future cash flow obligations or benefits. Large deferred tax assets may also raise concerns regarding realizability if future taxable income may be insufficient to utilize available tax deductions or loss carryforwards effectively. The program emphasizes that tax differences affect not only balance sheet accounts but also earnings quality and cash flow analysis. A company reporting high accounting earnings but low taxable income may benefit from temporary tax advantages, although future tax liabilities could eventually reduce future cash flows. Conversely, firms with substantial deferred tax assets may improve future profitability if those tax benefits become realizable. Analysts therefore compare effective tax rates, statutory tax rates, and cash taxes paid to evaluate the sustainability of reported earnings. Significant changes in deferred tax balances, valuation allowances, or tax strategies may also indicate evolving operational conditions, regulatory risks, or aggressive financial reporting practices requiring additional investigation. Understanding differences between accounting profit and taxable income is essential for accurate financial statement analysis, valuation, and forecasting. Tax accounting involves complex rules and substantial management judgment regarding future profitability, tax planning strategies, and the realization of deferred tax assets. Analysts integrate tax analysis with profitability, cash flow, and solvency assessments to evaluate a company's true economic performance and future financial obligations. Transparent tax disclosures improve investor confidence and allow better comparison across firms operating under different tax jurisdictions and accounting systems. A strong understanding of accounting tax differences enables analysts to interpret financial statements more accurately, evaluate earnings quality, and make better investment, lending, and valuation decisions in global financial markets.